Hi, it's Aoife and Devitt, and welcome to today's Markets Happy Hour podcast. I am joined today by Pablo Castro. He's joined here as a guest. Welcome, Pablo. Thank you for joining us.
Thank you, Ethan.
And as usual, I'm going to bring up the slides and we will kick this off. I've entitled this podcast Show and Tell as we're featuring Mount Aconcagua from Argentina here. As before, we have discussed Argentina as a laboratory, and thanks to having Pablo on the podcast, we are going to reflect on some of the recent election results there. We're going to reflect on some of the economic circumstances and bring that to the developed markets reality and to see if there's anything we can learn from the other here. So that's the Show and Tell title. As usual, we are going to cycle through inflation, geopolitics, equity markets, interest rates, and other asset classes and how they relate to the portfolio. And where we're going to be speaking a little bit today is the revisions. We are seeing some revisions when it comes to macro data, particularly around labor, around inflation. We're going to discuss the Fed independence and look at that in the context of the broader independence for international institutions. We're going to discuss equity markets, do a particular deep dive on the recent Argentine elections and some of the economic indicators down there. And as always, ask whether there's anything that we would recommend you do in your portfolio as a result of that. So here is today's special guest, Pablo Castro. He's based in Buenos Aires. We met when I was down there recently. He works as an economic consultant and has spent over 17 years in London in various roles at Bloomberg, including as a structured credit and broader fixed income specialist. He's also a podcast host. He has a political and economic podcast, which he has in Spanish, that's hosted with the Economista newspaper. And he is also a macroeconomics lecturer at the University of Buenos Aires. So welcome again, Pablo. We're looking forward to hearing your insights.
Thank you very much for having me, Ethan.
Well, let's kick this off. We usually kick this off with an inflation discussion and a little bit of a vibe check. So these slides were prepared before the US CPI number came out at slightly higher than the last month's read, but according to expectations, so just over 2.5%. And we have been looking at a general movement in inflation, which has been coming down, but not kind of to the 2% level. And what we have seen here is that, as usual, it is not having necessarily universal effect. That inflation has erased US income gains last year, with the higher income households generally faring better. So, in terms of feeding into that, we know that oil stocks inventories are high. So, that's likely to keep downward pressure on the oil price. But overall, we have inflation coming into line, but still feeling the pinch. And certainly, when we look at inflation indicators, we have both the hard indicators that we're reading today, and then we have the expectations, that consumer expectations around inflation. And what we've seen in a somewhat optimistic move is that consumer inflation expectations have started to come down. This may be because of the tariff narrative that is suggesting that tariffs have already essentially been a wash. They have come through the system and have not had an effect. But we are still having the sense that there is perhaps more to come in terms of tariff effect. And when I mention the word inflation, Argentina obviously comes to mind. Pablo, clearly a country that in recent years has dealt with hyperinflation, a persistent inflation. Any insights from you in terms of what is happening on the ground in Argentina today, and maybe on the developed market development of inflation as well?
Sure. Well, on developed markets, I'm a little bit skeptic as to the tariff effects and whether that's going to pan out as the optimists um, say it will. In Argentina, obviously, we're experts in inflation. That's one of the things we have a lot of experience on. Obviously, there is an stabilization plan in place right now. The current government came in, and one of the big differences, obviously, is we tend to measure inflation in monthly levels as opposed to yearly levels because things are so volatile and orders of magnitude are different. So when Milei came in, inflation was running around 25% a month. And yesterday we had the latest data point was 1.9 a month, right? So that's so we're now in the 25 to 30% yearly inflation rate, which is a massive improvement from more than 200 at the beginning of tenure. Obviously, there's been a huge change, huge changes.
And I have a slide here about consumer expectations. And clearly, that's something that the central banks have been trying to control because that can affect, hoarding behavior. Can actually kind of pull forward inflation. It can be self-fulfilling. How have consumers generally in Argentina reacted? Obviously, this is a much more extreme case there. But how has it affected behavior in terms of hoarding? Obviously, we talked earlier about the it not being universally felt. Any kind of comment on just that impact there?
Yeah, everything here when you try and compare it to like a developed market uh, working is much more extreme. Swings are so extreme, right? So when you look at the initial part of Malay's stabilization plan, there was a sharp devaluation and a massive fiscal consolidation. We're talking about in some areas of government spending, you had cuts of 30%. So these are massive cuts to the economy and to purchasing power of many individuals, many consumers. And you had a very quick recession. At the same time, inflation came down so quickly, and that in itself, created some expansionary effect. And now, over time, the FX policy meant that the peso became more overvalued. Because the government has been depreciating the currency at a 1% monthly rate, and inflation has been above that. So every month you were losing you were appreciating in real terms. Therefore, at the by April, the currency substantially overvalued, I would say, and that started to affect activity, and a lot of businesses um, it became very difficult for them to compete with foreign products. It became very difficult for tourism as an industry, for example. So since then, we've had activity, fairly, moving sideways, so to speak, or even a little bit down with some areas like construction industry, it decreasing, and consumer confidence falling quite sharply. So first now is that this movement of a currency has been undone progressively over the past few months. So that points to some movement in the opposite direction in the coming months. Expect, depending on a lot of political uncertainty and so on, but I would expect things to turn around in the next few months.
And I did bring up the chart there showing that the currency has lost 25% versus the dollar since it was floated in April. Also quite a bit since I was there. So that was obviously as a tourist, I felt that pain a little bit of the recent strength in that. Just going back then to thank you for those insights, and we'll come back to some of these metrics later. Another big feature that has been in the headlines recently has been around central bank independence, as we all wait with bated breath to hear what the next move of the Fed will be with respect to interest rates. We have heard today that the ECB has held firm at 2%, despite the fact that there is probably a sputtering economy in Europe. There was still not a desire to fan the flames potentially of inflation any further, and very much a kind of a watch and wait approach by the ECB. But we've still been discussing quite vigorously, I'd say, in the Federal Reserve independence here in the US. And not only have we had a court order blocking the removal of the governor, so for now there is no removal of the governor, Lisa Cook. But we have had this Treasury Secretary weighing in, suggesting that the Federal Reserve has been driving inequality within the US by keeping inflation high for as long as it did, by being slow to react to inflation. suggesting it must regain its independence, which is kind of an extraordinary suggestion, as actually some of the suggestion around the current administration is that it is seeking to thwart its independence, and we would suggest that it is independent. So I'm not sure if this means independence from a so-called deep state or independence from the executive, but I would say that certainly we are now. This has become a real debate as to whether or not the Fed should be independent and what that actually means. And that, of course, has far-ranking ramifications for the respect for the institution and I suppose its stability. Switching now to Argentina, this has been a narrative that has been woven recently, not only in Argentina but other countries in Latin America, that they have tested their institutions. Their institutions have withstood the test of time, and actually that the central bank governor is among the most respected senior members of the government there. So, how would you say the experience that you've seen in Argentina has led you to think about this issue?
Well, first of all, in Argentina, central bank is not independent for sure. It's completely subordinated to the Ministry of Finance, um, which for the current experiment, as you call it, is probably fine because the country is in sort of emergency mode, and many things need to be fixed, and central bank independence is probably sort of the end of that process, not the beginning. Many other countries in Latin America have been able to build very credible central bank independence, and they've done very well out of it. So I tend to think that things in the developed world a lot through that prism, because if you think of it, this debate in the US is not going anywhere, especially next year. I think Powell's tenure comes to an end in May, and that's going to be another issue where probably the administration will try to put their foot in. And in the UK also, there's some debate right now about central bank independence. The way the conservatives in the UK tend to think about it is there's some kind of you called it just deep state, but there's let's say some Keynesian establishment or something like that that prevents democratically elected politicians from achieving their goals. However, I think this is by design, and it was not a coincidence, right? Central bank independence in the developed world is very much tied to much lower inflation rates historically. Um, and when designing any institution, you kind of have to bear in mind what would happen when that institution is hands of your opponent in the political world, right? So in the UK, it could be, I don't know, Jeremy Corbyn, or in the US, it could be uh, Alex AOC, right? Or Bernie Sanders or whoever. What I'm saying is, once you undermine central bank independence, then the floodgates are potentially open for the government to ask the central bank to print money or do some kind of QE or something like that, which I think is very relevant for a lot of the issues in Europe right now, where you have a ton of countries that have very high debt as a percentage of GDP, and a very complex political problems of how to solve, right? And if you think that as we say here, the thread tends to break at the thinnest point, then central bank independence is definitely somewhere you could see um, European countries or the UK or even the US, going against that and basically addressing the problem of high debt through higher inflation and and let's say lower real interest rates um, over time.
It is interesting. I mentioned your previous alma mater there, Bloomberg's Odd Lots podcast interview with Liz Truss was very interesting on this point. But I think the suggestion there was that currently the government these institutions are run by unelected bureaucrats. But that would actually be the point. I think in some cases they would suggest that the fact that they are apolitical, they are long term, 14 years in the case of the Fed, that they are allowed to sort of look through electoral cycles and actually make long-term strategic decisions that are in line with economic orthodoxy, and actually have that kind of strategic vision. So I don't think this debate is over. As you said, it is continuing to rage, and the next it was point of discussion will obviously be in the US when we hear what the Fed does do, and we should know that very soon. But I say, just to finish up the vibe check on the US before we discuss markets and move into discuss Argentina, I'd say that there is, continues to be some concern that some of the all this buoyant news around the economy is not quite as we've heard before. Just very quickly to go through this, we have seen a report of a troubled subprime auto lender. That sounds awfully like 2008 when we started hearing about subprime and some of their overstretched nature. And larger banks like JP Morgan and Fifth Third have losses tied to that. So not all is sunny in the consumer space. We have talked about a low hiring, low firing job market. So very unexciting in terms of some of the numbers, but equally we've had some revisions downwards to that. Basically, one of the largest revisions downwards to non-farm payrolls that we've seen in recent times. So clearly not heading in the right direction there. That would, of course, that so-called bad news be interpreted as good news when it comes to the Fed and its cuts, but clearly not a particularly great job market. And by the same token, for small businesses, that is actually positive. They found that their jobs are easier to fill. They're not having to compete as much for talent, and equally that price of labor has been more contained. So I suppose every cloud has a silver lining, and that seems to be the silver lining when it comes to employment there. The other pattern relating to bonds, and we'll touch on this in the Argentinian situation later, is we have talked about the gilt yields in the UK and the French the government bond yields spiking, and that's been a global phenomenon. We have seen, interestingly, that has come in just a little despite the collapse of the government in France there. I'm now moving to equity markets. So we are still at record highs here. Some of this been driven by deeper rate cuts. And we have seen a little bit of a stall after an August record, but still very positive equity markets overall, despite some of the news flow on the geopolitical front being quite negative. Of course, the backdrop then here that there is an abundance of noise on the geopolitical side as well. We've seen France, I mentioned before, the collapse of the government there, and a concern that the bailout that France would need, if it does need one, would simply be too large to countenance. So quite a bit of uncertainty around France. We've also seen, as the war in Ukraine continues to rumble, we've seen NATO forces shoot down Russian drones over Poland. So the beginning of that sort of starting to bleed outside the borders. And then, while the US has been distracted with personal distractions on the part of the administration, we've seen the Israel targeting its Hamas in Qatar. So quite a bit of expansion, and I'd say just this ongoing rumbling of geopolitics, which just adds to the noise for investors. And now let's move to Argentina. So we're recording this, as I mentioned, September 11th, and there has been quite a bit of political news featuring Argentina. That's where I got these slides from recent news coverage around the recent elections in Buenos Aires, the vote there, which is being at least described as a blow to President Milei. And a great setback to some of his reforms, and at least sows the seeds perhaps for a tighter contest in the congressional elections coming up. I'd love to get your read on both the election outcome. Was this expected? What does it mean? And we'll go from there.
Right. Yeah. So the election that happened last Sunday was a local election in Buenos Aires province. Buenos Aires province is the largest and is home to about 40% of the population. So it's very significant in terms of the population. It's not as significant in terms of Congress. So in terms of what the votes that go into Congress, right? The province is underrepresented in the National Congress, and smaller provinces, um, more sort of north or south, tend to have a higher, tend to be overrepresented in the National Assembly. Now, when you look at Milei's set of reforms, there are clear winners and losers, and some of the winners are some of these smaller provinces because they are natural resource rich. They tend to be big beneficiaries of all the new investment that's happening in oil and gas and mining and things like that. Um, and a lot of the cuts that were done by the government were especially in subsidies that were focused in, on the population around the Buenos Aires area. So for a lot of these people in the interior of Argentina, this is not a bad trade, let's say, where they get cheaper products from abroad because the government is opening the economy, and they get lower inflation uh, in exchange for less subsidies for these other people in Buenos Aires. Now, for the people in Buenos Aires, it's not necessarily that great. So I think we're seeing a little bit of the worst result, or a result in the area that's been most adversely affected by the plan. So that's what I would say as a caveat. The result itself was within what we had forecast, but still very, the margins were much larger. So that was very surprising. I think the market was more positioned to 5 to 7% loss. It was more like 13%, right? And there's some discussion there about the turnout, and especially some of the softer voters of Milei, that older voters that potentially are not in sync with the president's, say, style or communication style, and an aggressive demeanor or whatever. So some of them may have not turned out because turnout in general was lower than usual. So all of that points out, towards the elections in October should be more positive to the government, and those are the ones that really count for the government being able to continue the economic plan, and also being able to maybe pass some reforms. Having said that, I don't think that the government will make a huge a great election, but they should be able to improve their numbers, because their numbers were very low to begin with, right? They started with 1/6 of the lower chamber, and even less than that in the Senate. So they only have upside pretty much in these elections. We'll see how it pans out. I think a lot of it will be reliant on this on the economy turning around based on the effects and the real exchange rate, and whether the government can ride this turmoil. Yeah.
It's so interesting. And I think, I call this show and tell because there are so many parallels between the outcome of the election there and something we see in the United States. I think sometimes a shock result like that can galvanize the non-voters, can increase the participation. And I always love the expression by President Biden, which was, don't compare me to the almighty, compare me to the alternative. So while President Milei may not be perfect in many ways, I think if the population is forced to choose between the alternative and him, it may well force the issue on support. And I have heard that too about the regional divide. So very interesting insight. And then just to bring up the next chart that I touched on earlier, we are seeing. Obviously, a direct reflection in asset prices, having seen that markets were down 28% year to date to the previous chart, although ticking up about 4.6% in the aftermath as the results are digested, as you have done. And we've kind of put them into context. The currency clearly down, and the dollar bonds tumbling to 2024 prices. So this might suggest that there could be a buying opportunity if and when things normalize, or if there is actually a positive outcome. I'm not sure if you would see it that way.
Yeah, I mean, some of the energy companies, for example, are at the cheapest levels they've been, and I still think, or at least we're fairly positive on them because even in the event of a different government taking over in 2027, there's still pretty much a big political consensus that have been built around the energy sector. So we tend to be sort of optimistic on them. And then when you look at some of the banks also, they're trading at probably the lowest, sort of like uh, price to book, very, very low price to book ratios. So yeah, probably a very good buying opportunity. Yeah.
And then just to finish on other asset classes, so just to continue some of the momentum we've seen in recent years, we can see that gold is continuing to surge. Again, perhaps a reflection of some of this concern around the bonds, around the state of governments, as we talked about, governments being in various frail states. And interestingly, who's buying the gold? It does seem that China is piling into gold, and perhaps at the expense of the dollar. And we haven't shown a dollar chart today, but the dollar has been showing weakness, and some of the beneficiaries of that have been gold, clearly, and also the euro. And this is to bring this discussion to an end. So it is being September 11th. Obviously, this is a massive day of reflection in the United States, and I think this has been a great opportunity with you, Pablo, to engage in some reflection, not only on where we are here in developed markets, but on how the laboratory of Argentina can teach us maybe both how to cope with extremes, but also what to expect. And I think having your on the ground insight has been great to clarify and provide more depth around some of the sensational headlines, which really do nothing more than scratch the surface. So thank you very much for coming here and for sharing your insights with us.
Thank you very much, Effin. A pleasure.